Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/the smattering, to get access to the 10 best stocks to buy right now. This week, bank stocks have absolutely taken it on the nose. It has been brutal between Silicon Valley Bank's failure, Signature Bank joining it, both being taken over by the FDIC, and two stocks that look like they're going to end up being zeros for investors. There's a lot of fear right now. But I'll tell you right now, I ran towards this fire and made some pretty significant investments. I invested new money in 4 bank stocks that I already owned, and now banks make up almost 10% of my portfolio. I want to talk a little bit about the banks that I bought, talk about why I did. I'm Jason Hall. This is The Smattering. I've got Tyler Crow here with me. Hey, Tyler.
You know, Jason, whenever you want to hash out an idea, I feel like I'm the one that you call up. Even though we live 8-9 time zones away, we do this anyways.
Well, thank goodness for daylight saving time now. It is only 8 hours difference now, so that makes life a little bit easier for you. So Tyler, with that said, I want to share, here's what's happened with the 4 bank stocks that I already owned that I added more to, and we'll start with SoFi Technologies, ticker SOFI. You see the purple here, it's down almost 20%. We're recording this late in the afternoon of March 17th. And then you look at the others, you see Central Pacific Financial, the regional bank based in Hawaii, down almost 16%. Live Oak Bankshares down the most, down over 23%, and another 20% decline for Bank of NT, Butterfield, and Sun. So you see all of these have substantially fallen. And again, I owned every single one of those. So my existing positions have all fallen substantially. Now, let me talk about why I've decided to buy right now. Tyler, we think about everything that's happened with Signature Bank and SVB Financial. This was really a crisis of confidence with their depositors, primarily businesses, with the vast majority of the dollars deposited in those banks above the FDIC limit for insured deposits. There was a crisis of confidence that the banks would be able to remain solvent, and the FDIC took them over. We know that because there was a bank run at Silicon Valley Bank. When they took over Friday morning, it was negative $1 billion in terms of capital to deploy back to depositors.
It also didn't help that the 2 banks that they took over, a lot of their depositors were kind of correlated, and they were in the same business. They had a lot of internal connections. So an added wrinkle.
Well, and it's an important one, right? Because if you think about trying to diversify not just your opportunity, but also the risks you're exposed to. So when all of your customers kind of they're tied to the same risk factors, you're directly tied to all of those risk factors too. And I'm glad you brought that up, Tyler, because I think it's a really important part of the reason why with each of these banks that I added to, I felt confident that this temporary crisis we're seeing is very less likely to result in contagion, as they're calling it, carrying over to them. I'm going to start with Live Oak Bank because, again, this is the one the stock is down maybe the most. It's down the most of all these. It's down more than 23%. And the biggest reason is on its surface, it sounds a lot like Silicon Valley Bank. Their tagline is to be America's bank for small businesses. That sounds a little concerning, right? If you're thinking about concentration of risk. But here's where Live Oak Bank is very different than Silicon Valley Bank. And that Silicon Valley Bank relied on deposits from startups, right? They deposit their money in Silicon Valley Bank, private banking for the founders and lending to them, things like margin loans. And so it's like everything is very heavily tied to those particular clients that are all very correlated in the things that they're bringing.
Correlated, like we just said, correlated. They're connected in some way.
Exactly. So then you have Live Oak Bank that says, yeah, we're America's bank for small businesses. Where they're different is that Live Oak is steadily building out lending and financial services to small businesses in different industries. It has a really good history of finding industries that it learns about to be able to underwrite really well in those industries. And then it goes after them and starts slowly, steadily building up its book of business. Now that's its lending business. Its deposit business is you and me. It's almost entirely made up of retail banking. That what they specifically do is they market high yield CDs and high yield savings to generate stable deposits from people that put the money in the bank and they leave it there. because that's savings. It's there to try to generate yield. It's not a startup that's burning cash that's got to make payroll, right? So it's not exposed to those same correlative risk factors that we saw for Signature Bank and that we saw for Silicon Valley Bank.
Which certainly makes sense. Like there's a lot of things that we want to talk about now with banks, and it all comes down to risk, right? It's like depositor correlation and duration risk and all of this, the new terms that have immediately become part of the zeitgeist of conversation. And so when I hear this, it kind of makes sense. But you mentioned at the top, like, I don't have a lot of banking exposure, right? And so, with somebody like you who use that as an opportunity to, we're going to go a little existential here, but you took your invested knowledge capital and deployed it at an opportune time. Having the intellectual capital to deploy at moments of crisis is incredibly valuable. And investors, if you're looking at situations like this, know if you have intellectual capital to deploy at moments like this, because that is where you're going to generate good returns.
I'm really glad you brought that up, because I think that's the key. Is if we're going to be honest with ourselves and we look at the volatility of so many banks, a substantial amount of it is trading activity, and a lot of it is from people that are just chasing opportunity, not knowing really what they're investing in. And it creates substantial risk as an individual investor trying to trade on an idea that you don't understand. Because I understand the business that I own, number one, and then it inoculates me to a certain extent from fear about the near term and seeing the stock fall and then being afraid, okay, there goes my money. I have to get out before it gets worse, because I understand a Live Oak Bank doesn't have the exposure to the kind of deposit risks that we saw with Signature and Silicon Valley Bank. To understand that Central Pacific Financial, it's a Hawaiian bank, and Hawaiian banks are kind of immune to a lot of the outside threats from the big banks of coming in and taking away market share. Understanding that SoFi, for example, while they kind of taken this same approach as Live Oak Bank to growing with like high yield savings to attract savers, they can make money because a lot of their personal loans are adjustable rate. So as rates are going up on deposits, they're also getting higher yields on their adjustable rate personal loans that they've made. So understanding those aspects of these businesses, like you said, is absolutely critical. And it's how you find these opportunities, but it's also how you avoid, like you were saying, not chasing something that you don't understand that just results in you ended up losing money